Welcome to the deep dive. You know, earnings calls can seem pretty dry, right? It's just a lot of corporate jargon. But they're actually one of the clearest roadmaps a company gives you. So our mission today is to give you that shortcut. We're going to analyze the strategy and the key insights from just the CEO's opening remarks. We're talking about the Walt Disney Company's Q4 2025 report. So we're diving into what Bob Iger had to say. And this wasn't just a quarterly review. It felt more like a statement on where they're heading for the next decade.
Oh, absolutely. That's exactly right. Iger basically framed everything around two main pillars. First, just relentlessly using their creative assets, their IP.
Wow.
And second, showing that the huge investment in their digital business, their direct-to-consumer stuff, has finally paid off.
Right.
After all the volatility of the last few years, the whole narrative now is just, it's about stability. It's about execution.
Okay, let's unpack this. And I think we have to start with the financial foundation because, I mean, that's what's paying for everything else they're doing.
Yeah, the CEO was really focused on sustained long-term growth. So he announced that adjusted earnings per share, EPS, which is that key profitability metric, it was up 19% for fiscal 2025.
Which is a strong number on its own.
It is, but what's more critical is the consistency. He pointed out they've delivered a 19% compound annual growth rate, a CAGR, in that same metric over the last 3 years.
Wow.
That kind of compounding success, it just gives them immense strategic flexibility.
And you can see that confidence being immediately translated into returns for shareholders. I mean, the capital return announcement, that was maybe the loudest signal in the whole call. They're targeting an incredible $7 billion in share repurchases in 2026.
It's a huge number.
Yeah.
Doubling it to $7 billion from the $3.5 billion they did in fiscal 2025. That is a definitive statement.
What does that statement say to you?
It says they have extreme confidence in their cash flow and their operational control, and that their balance sheet is just rock solid.
Let me just challenge that for a second, though. When a company doubles its buybacks like that, I mean, that's a huge amount of capital going to its own stock. Does that also suggest that maybe they're slowing down on looking for big transformative acquisitions? Or are they just telling the market, hey, our stock is the best investment we can find right now?
That's a really important question. It's all about capital allocation. And while it definitely rewards shareholders right away, and let's not forget the 50% jump in the dividend to $1.50 a share, it does suggest that for now, they're prioritizing returning that cash over, another massive acquisition.
So building up the fortress.
Exactly. They're signaling they can grow organically while rewarding the owners. It's a calculated move to maximize that EPS performance right now.
And that financial strength, it all comes from their storytelling machine. Which brings us to, the power of their content.
Right, and what stood out to me here was how the CEO used just a single piece of IP to show how the entire company ecosystem works together.
And that was Lilo and Stitch.
The live-action Stitch, yeah.
He mentioned it was the highest-grossing Hollywood film globally for the calendar year so far. A foundational IP just proving it still got it.
It does. But the movie was just step one.
The first domino.
Exactly.
Yeah.
Its success then immediately flowed into their digital platforms. It got 14.3 million views in its first 5 days on Disney+.
Which made it their second biggest live-action premiere ever on the service.
It's that immediate synergy. Theatrical release drives streaming engagement right away.
But here's the real eye-opener for me, the number that just sort of underscores the whole strategy. Retail sales for Stitched consumer products alone eclipsed $4 billion in fiscal 2025.
It's an astonishing figure.
That's the proof right there. The IP isn't just selling movie tickets, it's driving massive high-margin revenue at every single touch point.
And that engine is what funds everything else. The CEO was clear this wasn't a one-off. Over the last 2 years, the studios have delivered 4 global hits that made over $1 billion each.
And he made a point of saying no other Hollywood studio managed even one in that same period.
Plus, they crossed the $4 billion mark at the global box office for the 4th year in a row. That level of repeatable success with big franchises, it's just unmatched.
And they're clearly planning to keep that going. They mentioned a few big ones coming up, Avatar, Fire and Ash for the holidays, Toy Story 5.
And the next big superhero event, Avengers Doomsday.
Right, and it wasn't just film, he also touched on TV.
Yeah, the focus there was also on high-performing, valuable content. You had huge viewership with Alien Earth on FX, which was the biggest Disney Plus and Hulu premiere for that network.
And that wild record from Dancing with the Stars.
Almost unbelievable. Season 34 was the first show since 1991 to grow its audience for 6 straight weeks. It just shows they're executing really well in their traditional TV assets, too.
And we can't ignore the cultural impact of what's coming. They confirmed the Scrubs revival, Percy Jackson, and something that's relevant to just about everyone, the Taylor Swift End of an Era docuseries and the Eras Tour concert film. Here's where it gets really interesting, though. Because that content machine, it wouldn't matter if the distribution model was still broken. Let's talk about the streaming story, the DTC turnaround.
That narrative is decisively over. I mean, the scale of this shift is the biggest news in the entire report.
What were the numbers?
The CEO announced that the DTC segment's operating income was up 39% in Q4. But the big one, full-year operating income, hit $1.3 billion.
$1.3 billion, and that was, what, $300 million ahead of what they had even guided for?
Yeah, $300 million ahead of guidance.
And the context here is so important for you to understand. Just 3 years ago, that same DTC business was running a crushing $4 billion operating loss.
A $4 billion loss.
To go from negative $4 billion to positive $1.3 billion in that short of a time, I mean, that's just an incredible operational achievement.
It's an extraordinary pivot. But we should be clear about how they did it. It wasn't magic. This profit reflects some really aggressive discipline. Substantial cuts to general entertainment content spending, for one. And a very successful strategy of raising prices to maximize the revenue per user.
So they traded that growth at all costs mentality for immediate profit.
They did. The challenge now is to prove that this margin growth is sustainable without hurting the quality of the IP in the long run.
And that whole transition required consolidation, right? He talked a lot about building DTC into a core growth engine through one unified app.
The goal is to simplify everything. By putting all domestic entertainment content into one app, they're getting rid of friction, they're boosting retention, and they're showing consumers the full value of the bundles.
Which is where Hulu fits in.
Right. Hulu becoming the global general entertainment brand in October was a big part of that strategic cleanup.
And sports are obviously central to that bundle. They celebrated the launch of ESPN's full direct-to-consumer service.
Finally, making that whole suite of services available directly for the first time, the enhanced app is packed with features: multi-view, betting, fantasy, commerce. It's designed to be sticky.
And it seems to be working. ESPN's network ratings were up 25% over the prior year's quarter.
The payoff is immediate.
And here's the stat that validates that whole strategy for me. He said that about 80% of the subscribers to the new ESPN service signed up for the Trio bundle.
The Trio bundle, so with Disney Plus and Hulu.
Exactly. That one statistic proves that bundling is the key. It's how you lower churn and maximize how much a subscriber is worth over their lifetime.
Absolutely. The CEO's goal is crystal clear. Make the household relationship so valuable that it's just too complicated to leave.
Okay, so let's move to the third leg of the stool. The experiences segment. Parks, resorts, cruises. This part of the business also delivered record operating income.
Yeah, for both the quarter and the full fiscal year. That's a crucial point. Q4 OI was up 13%, full year up 8%.
So it's a financial powerhouse.
It is, but the strategy is all about aggressive, long-term global investment, especially in cruising.
Right. They have 2 new ships coming online almost immediately.
The Disney Destiny is sailing next week, and then the Disney Adventure. That's the first ship they're home porting in Asia. That one launches in March.
And that brings the fleet to 8 ships. But the long-term plan is even bigger.
Much bigger. 5 additional cruise ships are already scheduled for launch beyond fiscal 2026. This isn't just maintenance. This is aggressive expansion.
It really feels like a hedge against, potential saturation in the streaming market down the line.
I think so. Parks and cruises offer these high-price physical experiences that you just can't digitize. They're doubling down on what can't be copied.
And we're seeing that same aggression in the parks. World of Frozen is opening at Disneyland Paris in the spring.
And they made it a point to say that there are expansion projects underway at every single theme park they operate in the world.
Plus the huge news, a brand new theme park planned for Abu Dhabi.
Which tells you exactly where they see the biggest geographical growth potential, moving well outside of their established markets.
Right. The CEO really stressed that these massive investments are happening now to make sure their parks and cruises stay best in class for the next generation. So what does this all mean? The CEO's message was really one of highly effective execution. He painted a picture of a company that's moved past the expensive build-out phase of streaming and is now just focused on generating profitable cash flow, to build for the future and, create value for shareholders right now.
Yeah, I think the two key takeaways for you are, first, the incredible speed of that DTC turnaround, even if it was achieved with aggressive cost controls and pricing. And second, that masterclass in synchronized IP monetization, the Stitch example. A movie success seamlessly driving $4 billion in retail products. That synergy is their competitive moat.
And that synergy, that's what leads us to our final provocative thought. So the CEO outlined this massive global growth in experiences, right? 8 cruise ships, expansions everywhere, a new park in Abu Dhabi. Given this intense focus on physical global expansion, the big question is this: what new touch points or technologies do the DTC platforms need to integrate to truly become that portal to all things Disney he talked about, and tie all this physical growth seamlessly back to the digital consumer? Something for you to mull over until our next deep dive.